Hello, everybody, and welcome to our virtual tax school webinar series. My name is Amar Medic, and I'm the product marketing manager here at TaxWise. We hope that you had a great tax season, and thank you for joining us today. Today's topic will be maximizing Schedule E deductions. Whether you're a first-time filer or simply looking to refresh your knowledge, this webinar will provide you with valuable insights and practical tips on how to maximize your client's Schedule E deductions. Keep in mind that we try to host one webinar per month, so please feel free to join us in the future as well if you find today's session to be informative. Throughout the webinar, you'll be able to submit questions to the team and get those answered live. We'll also have some polling questions for you that you can answer as we go. With that said, I'm very pleased to introduce our speaker for today, Mr. Ryan Hubbs. He is a solutions architect here at Wolters Kluwer. Ryan has years of experience working in the tax industry and will be sharing his insights on how you can maximize Schedule E deductions for your clients. So with that, let's get started. Ryan, please take it away.
All right, thank you so much for the kind introduction. And yes, today we'll be going over the Schedule E. And for those of you that have not joined one of these virtual tax schools before, the way that I always try to set these up is there will be some basic beginner knowledge at the start. We'll move into more intermediate items in the middle of this presentation, and then we'll move into more advanced topics towards the end. And I always like to set it up this way, so regardless of one of the attendees' level of tax proficiency or tax knowledge, everyone should be walking away, hopefully, with some valuable information. And before we really start getting into the Schedule E and some of these specific deductions that I want to go ahead and talk about today, just want to give you a very brief introduction on myself, who I am, what I currently do, and then we'll start to navigate more towards the tax side of this presentation. But just to kind of reiterate what was previously said, my name is Ryan Hubbs, and I currently work for Wolters Kluwer. I'm a solution architect, and solution architect is really just a fancy way of saying I'm a product specialist. I go into the products, I use my tax knowledge to show off how to use specific tax softwares and things like that. I do have my background in accounting. It's what I went to college for. It's what my degree is in. After I graduated, I moved up to Washington, D.C., and I worked for 2 CPA firms up there for a number of years. And I did a number of different engagements. I did some audits, I did some work with the government, some nonprofit work as well. But the vast majority of what I was doing was taxes. And this last tax season will have made it about 12 years that I've been doing taxes, really since the first year I graduated, moved up to DC and immediately started doing tax returns. So I can definitely relate to the struggle and the grind of busy season, trying to get so much work done in such a condensed amount of time. I'm very happy for all of you that busy season has just ended. I hope you were able to treat yourself to a nice vacation, and I'm glad that you're here wanting to learn a little bit more about taxation to further advance your knowledge within this field. Now, getting into today's specific objectives. Like I was saying earlier, I always like to set up these presentations where at the start, we're gonna go over the bare basics. We're gonna talk about who's eligible to file a Schedule E. And we're also going to be talking about identifying different types of rental properties that will need to file this specific schedule. And, sometimes I think it's pretty obvious. If I owned a house and, I moved out and I rented that house, obviously that's a Schedule E, but sometimes there can be some gray areas. How does Airbnb work? What happens if I'm just renting out a house, just a room within my house, but I'm still living there? Sometimes those are really the areas where there may be some areas where you're not quite sure what to do. We'll just talk about some of those basics. We're going to understand some of the various deductions. We're really going to drill down deep into travel expenses during this presentation. The reason that I picked travel expenses is I think back 12 busy seasons ago, I was a staff accountant for a CPA firm doing tax returns. And I feel like if I could go back, I could have saved my clients quite a bit extra money on travel expenses. I think that there is a mindset, especially when you're newer, that if there are expenses, then some of them relate to a business or a rental, but some of them are personal. Can I take any of this? Should I not take it? So we're definitely going to dive into some specific examples of when to take this and when to not take these travel expenses. We're also going to talk about passive versus active income regarding real estate. This is an immensely important, even though it's kind of a simple distinction to make, but we'll be going over the differences. If someone is active, there is really tons and tons of savings that you can give your clients versus passive. It's really just going to be up to you to kind of know the IRS designations for passive versus active. We will be going over those designations in this presentation today. And then the last bullet point here, practical Schedule C examples using a tax preparation software. As opposed to when I've done a presentation similar to this in the past, we are really going to be getting into the tax software. We're going to start with a blank Schedule E and really be filling this out from scratch. I really want to get into the nuts and bolts and in a lot of ways talking about how to make your tax software work for you. If you have a good tax software, once you have set up a rental property, it should really be doing the majority of these calculations for you. You're just going to be plugging in a few numbers here or there, and you really want the tax software to be doing the work for you. You don't ever want to have to go into a calculator and maybe do it by hand. It's really about using the tools that we have, because these tools, one, make sure that we're getting through tax returns probably more accurately, but absolutely more quickly. So with all that being said, let's go ahead and talk about our first bullet point, and let's talk about identifying who files the Schedule E. Now, the Schedule E is a very versatile form that the IRS has given us. And today's presentation is really going to focus on rental income. I think this is probably most definitely the most common reason a Schedule E is filed. But if you've been doing taxes, there are other reasons to use this form. If you have royalties, partnership income, really those K1s from estates and trust, maybe 1120S, these all go on the Schedule E. But today the focus is just going to be on the rental income, as I think this is the most common item that you'll be running into. And a common question that I get is, do I file a Schedule E if I'm just renting a basement or a room in my personal residence? And just to kind of set up this question a bit further, let's just kind of walk through and give this a little bit more detail. Let's say, for example, myself or yourself, you own a home and you have a mortgage on this home, or maybe it's paid off in full, doesn't really matter. What happens if you have a friend move in and they are scratching you a check for really any amount, $500, $1,000? The amount is really immaterial to the question. But if that is happening, should you file a Schedule E with the government, or is this just something that could be counted against your mortgage? And we're actually going to open this up to the first polling question here. If you're renting out that basement or your personal residence, are you going to file a Schedule E on your 1040? And these are really the kind of questions that I like to think about. I don't always just want to go over really black and white areas. I want to dive into these gray areas. As a tax professional, when I was first getting started, and I wanted all my tax returns to kind of be easy. I just wanted to know what the answers were. I wanted it to be cut and dry, very simple. But then over time, I started to realize, these people are coming to us because we are professionals. And when we get these complicated questions, these are really the reasons that they're paying us for this service. It's really up to us to know these, minor distinctions that the IRS guidelines are going to give us, that are really going to, maximize their deductions that are possible, or in some cases, maybe saving them from an audit. Sometimes it's just as important to know when to not take a deduction as to take a deduction. So I'm going to go ahead, and it looks like this polling question is already open. I'm going to give you all about 30 more seconds here to answer this question. And if you're not sure, that's totally fine. This is really meant to be a learning engagement where we can all gather more knowledge. So don't feel like this is a test and we're going to be saving these answers and attaching it to your account. It doesn't really matter what you answer, but just kind of want to get a feel for where you all are at. This also will help me down the line when preparing future presentations like this, to make sure that we're diving into content that you don't already know. So just whenever you're ready, we can go ahead with the polling results, and we can go ahead and continue on with our presentation from there.
All right, we've got about 85% voted so far. Okay, I will go ahead and close it. And it looks like 55% people said yes, 23 said no, and 23% said not sure.
Okay, great. I'm glad that we have a breakdown between the three categories. And to answer this question, technically, yes, you should be filing a Schedule E. I think a lot of times we view deductions and reporting income as an all or nothing. Well, this is either a rental property or it's not. If it's not a rental property, if I'm living there, this is something that I should not have to tell the IRS about. However, that's not always how it's going to be set up. You know, the IRS, is a general rule of thumb, wants to know. They want to know where your income's coming from. And even if they're not taxing you on it, in this instance, this would be taxable income, but even if they weren't taxing on it, is a general rule of thumb, just tell the IRS. You know, it's not our job to investigate our clients and dive down into the details of what's going on. But if we are presented with information or with knowledge that really would affect their taxes, you know, just always try to make sure that you're doing your best to report it as accurately as possible. You know, this is definitely a situation where if you did not report it on the Schedule E and your client got audited, this would be a tough one to explain, because technically, yes, you are supposed to. Now, I understand from a practical standpoint, you know, not all the time are our clients going to tell us about this. Our clients can be savvy about what to tell us and what not to tell us. But if you find out the answer is yes, you should file a Schedule E. And kind of diving in a little bit further, let's talk about some of these examples of Schedule E clients. And typically there's two broad categories, and I've listed both of these broad categories on the screen. And we will first talk about residential property. And you can see by the first bullet point, the client leases part of their home. This is going to be someone who would file a Schedule E. And this lease does not have to be in writing. This could just be a handshake. It could even be a situation where maybe you're helping a friend out. Hey, buddy, just, you know, go ahead, pay me $500 when you have it. If you don't have it, that's okay too. That's still going to qualify as a Schedule E rental. Really, the terms and conditions are not the important part. The important part is the exchanging of money in order for them to live within that specific residential property. Now, if they're living there for free, there is $0 in income. Well, the IRS isn't going to really care about that, as there's not going to be anything taxable. But if they're paying any monetary value whatsoever, as a general rule, always file the Schedule E. Moving down to the next bullet point here, I think this is going to be a little bit more black and white. If a client has moved out of their primary residence, maybe they've moved in, they've got a second house, maybe they've gone and bought a vacation house even, and we'll talk about that in just a second. But if they have moved out of the residence, or, you know, this slide could maybe even be updated, they really don't have to just move out of the residence. But if they just purchased a property even with the intent to lease it to a client, that is going to be a Schedule E client. I think out of all the examples on the screen, this would probably be the easiest one to see that distinction. And then lastly, we have the client has a vacation home, and think Airbnb. You know, as Airbnb and some of these other websites have really taken over, you know, a common thing that I hear is, well, it's like Uber or it's like Grubhub, and they'll get a 1099-K. The information should just be reported there. Schedule E's are really rental properties going to work different. They are going to go ahead and go on the Schedule E. And one of the things that we're going to be looking at in today's presentation is really setting up these vacation rentals. Maybe they're living there, they're going there to spend a month, 2 months, 3 months, doesn't really matter the length of time, and the rest of the year they're renting it out. Well, the IRS has some very specific guidelines for us that we're going to take a look at as to what is going to be fully deductible, as opposed to what is going to be partially deductible. And we'll talk about how to get to those calculations, and we'll talk about those different items as we get into this presentation. Now, on the right-hand side of the screen, we have business property. Now, this is something that I honestly, in regards to the Schedule E, ran into every now and then when doing taxes, but I didn't run into it a ton. Now, the technical answer to the question is obviously yes, they should file a Schedule E. But you kind of also have to think about, is this a business entity or is this just a person renting out you know, commercial property to a business? And the reason I'm making this distinction is most of the time, the overwhelming majority of the time, when there is a business renting a commercial property, well, they're usually renting it from another business. They've incorporated as a partnership or a 1120 corporation or 1120S. Not necessarily all the time, and that's why sometimes you will report this on a Schedule E. But whenever I see supporting documentation from a client saying, okay, yeah, I rent this out to a restaurant, I rent out this building to some various offices, or whatever the situation is, I will always go and first ask them, okay, so like who technically owns this? Do you own this as an individual, or have you set up a business that owns this? Just making sure that we're reporting the income on the correct tax return. Now, moving a bit forward before we actually go and jump into tax preparation software and going in and setting up a tax return with the Schedule E, I do briefly want to talk about passive versus active rental income. And when it comes to passive versus active, it's not overly complicated to figure out the distinction between the two. But the reason that it's going to be important is that passive income is going to have limitations on how much they can lose. And really, they can't lose anything. It's going to zero out. We'll look at an example of this in a second. But active income, this is going to be something where you can have a net operating loss on your rental property. If the repairs, the maintenance, the insurance is more money than you brought in, you'll be able to take a negative deduction on your tax return. And we'll talk about this in just a second. Just to kind of go through this distinction between both of these items, most rental income is going to be passive. And the reason that most rental income is going to be passive is that if it's active, you really have to be like a qualified, you have to work in the real estate business, and you have to spend a significant amount of your time in the real estate business. And just to kind of walk through this example, my best friend just recently bought a house. He's actually bought a handful of houses up in Baltimore, Maryland, and he's renting out all of these, but it's not a major time sink on his end. He's only spending about 200 hours, maybe 5 weeks of working on these properties. And so this is considered passive income. So even if you had a net operating loss on these rentals, the largest deduction you can take is zero, because you can't go into the negatives. When you're going to run into active items or active personnel or income is really when you have someone where this is their full-time job. And you can see by this slide, someone has to work 750 hours per year in real estate rental income and real estate rentals to be considered active. So my main thought is real estate agents, property management companies, things of this nature. By and large, most of the people that I work with are just renting out 1, 2, maybe a handful of different properties. By and large, they qualify as passive. If I know that this is someone's full-time gig, this is really how they're making the majority or all of their money, that's when it starts setting off the alerts in my brain that this may be someone who's active, and they may be able to get a much, much, much larger deduction with the IRS. And just to briefly work through this, I have the most basic and simple examples to kind of financially show what I'm talking about. We have the same amounts here between passive and active. We both have we both have incomes of $1,000, and we both have losses of $2,000. And when it comes to something being passive, well, the losses are twice what the income was, but they can't really take a deduction on their tax return. They can zero it out where they're not going to owe any money on this particular income category, but it can't go below zero. So even if this passive loss number was $5 million, just hypothetically, zero is still going to be the lowest it can go. So the IRS is setting some hard caps against what just normal people that don't work in this industry can take as their losses. You juxtapose this with active, same sort of situation. We have active income of $1,000. We have active losses of $2,000. Well, now we have a net active income loss of $1,000. And why this $1,000 is important, on the Schedule E itself, it's really not going to be owing anything, whether it's passive or active. But if they have other income category codes that are boosting that AGI, you can use this $1,000 to reduce their AGI, even if they had wages or whatever the category may be, they had a business. This can be used to reduce that number, and you kind of can take more losses. And a lot of times, if they are going to have a loss, it's really beneficial to really dive down and make sure that you're capturing each and every expense in order to maximize their deductions for their entire tax return, not just their Schedule E. And so with these basic categories that we've gone over, we've gone over who files, different types of properties. We've learned this distinction between passive and active. Where I'm going to want to go next is I want to go into our tax preparation software. And today I will be using TaxWise Online. And with TaxWise Online, one of the reasons that I like it is that when you set up a client for a rental property, the tax software is really going to be doing the majority of the work and the calculations for you. You may have to do some basic data entry to, report the items, but any calculations that may need to occur, it's really going to be on the tax software. And where we're going to go today is I'm going to go to my tax returns. Excuse me. And I went and set up a very basic Schedule E while preparing for this demonstration today. And when we open this up, I just want to make sure that I went ahead and deleted it, which it looks like I did, as I do want to start from scratch. And who we're going to be working with is Frank's Schedule E. And I did include some very basic wages, just so we have something for those active losses to deduct against in the future here. But where I want to go to set up some rental properties is I'm going to go and click on this add button on the left-hand side. And when I go to click on this add button, I'm just going to go ahead and type in Schedule E. We're going to add it to this return. And when we go and add it to this return, we're having some of the basic data flow through from where we previously entered it. But I just want to go and set up some of these items. Did you make any payments in 2022 that require you to file a 1099? Most commonly you will run into this if they have a management company, or if they have a very close relationship with a handyman or a maintenance company, in order to go and work on the house. For this example, though, I'm going to say no, and we're going to go ahead to option B, also click no. Now, when we scroll down, how this is going to be set up is there are going to be some different codes that the IRS want to know about the specific property that you are going ahead and leasing out to someone else. And a lot of times these codes are just for the IRS records. A lot of times it's not going to have a big impact on what their deductions are going to be, but it is something that's going to be required. So what I'm going to do is I'm actually going to go down to the address section, and I want to dive into some more detail for this specific property that we're about to input. I'm going to go ahead and click this link to button. I'm going to link this to a rental real estate option. And from here, just give it a very basic address, 1234 Main Street. Go ahead, put in an address, so the zip code, so the city and state form, we'll have this as taxpayer. And for this first example, we'll just go ahead and use code 1, single family. Actually, no, let's go with code 3. Let's go with a vacation rental so we can talk about setting these up when it's only a part-time rental. This is always going to be more complicated than a full-time rental. If something is a full-time rental, by and large, most or maybe even all of the expenses regarding that property are going to be deducted. I think it's a lot more black and white, cut and dry. When you come to these vacation rentals where, sometimes the owner's using it for their own personal benefit, but the majority of the year it's set up through like Airbnb or through a travel agency. That's really when there's going to be a little bit more legwork on your end to make sure that you're setting this up correctly. To not only maximize deductions, but also make sure that you're giving the IRS the correct deductions. So I'm going to go ahead and use code 3, and then we're going to talk about fair rental days versus personal use days. And this really gets back to this vacation home example. And with the fair rental days, these is simply just going to be the number of days that the property was rented. And this can be an important distinction. It's not the number of days that it was available to be rented. It's the number of days that it was actually rented. And for this example, I'm going to give it a pretty generous number here of 100 days. And for any of those days not rented, whether they're there, whether they weren't there, I'm going to go ahead and just say there were 265 personal use days. And why this inputting this information is important is we're going to want to go ahead and put in a percentage here of what time was this rented out. And for this example, I'm just going to go ahead and use a rough estimate of about 35%. And what this is going to do with the tax software is we're going to have some different columns here when we're actually reporting our deductions. We have rental and personal use, and we have rental only. And why this is going to be important is, we've set up our fair rental days and we've set up our personal use days. We have our percentage, but these two columns are independent of this percentage, just meaning if something is rental and personal use, well, you're only going to be able to take this percentage for the deduction. But even if you were living there, if you had some items that were just for the rental, that will still be fully deductible. And it's really going to be up to you to kind of cognitively think through it and figure out, okay, is this something that the owner was getting benefit from, or is this something that only the renters were getting that benefit from? And luckily on the screen for me here today, the first item really highlights this juxtaposition between the two. When it comes to advertising, if you are going and spending money and advertising a rental, well, there is no personal use that could be associated with that. The only reason you are advertising is to get renters into that vacation home. You don't have to advertise for yourself to use it. And you can see within our tax software, it's even set up this way where there isn't even a field to input advertising, is there's literally no reason why you would ever do this. So for this example, and actually I want to go and scroll up first before we start entering in these deductions. Let's go enter in some rental income, and let's say they had $35,000 in rental income. When I do this, the taxes are going to, jump up by quite a significant amount. These numbers, let me go ahead and close out of Microsoft Teams just so we don't have the pinging and the ponging. There we go. So these numbers on the screen are going to deduct our total amount. So for the advertising, we'll say, okay, we spent $2,000 on the advertising. Once we tab over, well, our federal balance is going down. And the next item, that will be on the list is auto and travel. I'm actually going to spend some time really diving down into the details of auto and travel, as I think this is a good gray area to kind of talk through when to take it, when not to take it, when to partially take it. But before we do that, let's talk about cleaning and maintenance. Now, let's say that the toilet broke within this rental property, and we need to go ahead and get a plumber in here. They need to go and fix it. Well, this is something that's going to be rental and personal use, because both of you are going to go ahead and grab value from this. Whoever is at that property for these days is going to get the benefit of it, and it's going to deduct based off this 35% rate. So I'm just going to go ahead and say this was a rather expensive plumber. It was $500. When we tab over, here's the tax software doing the calculation for us. It's looked at, okay, this was the total amount that we spent. This is the rental days percentage, and this is the amount that we're going to deduct. Now, there may be situations when this cleaning and maintenance is only for the renter. Maybe maybe you have a home that it's in a beach town, right? And you're going to be renting this out really just during the summer months when people want to go to the beach. Well, if you have someone come in and clean this after each and every use of a renter, well, really all of that's going to be deducted. Really the only instance that it would not be deducted is if you were just, that you were going to use this property, or your owner or the client was going to use this property, and they're hiring the cleaner for themselves. But as long as this is something that after each and every client uses it, or before each and every client uses it, this is really going to be 100% deductible. For this example, I'm going to put $1,200, and our amount due is continuing to dwindle downward. Now, some of these other options, commissions could be something that you run into. Typically, if you're using a real estate agent and you're paying them, commission on finding you a renter. I think this is a bit more rare, but you do run into it sometimes. Really, insurance is going to be one of these items where technically it could go into rental and personal use or rental, but most of the time when we think of insurance, we're thinking of, okay, we're insuring the entire property. In this situation, usually this is going to be divided up between the two, so we would input it onto this column. And since insurance has got quite a bit more expensive in the past really 2 years, we'll use a big number here. You can see the calculation occurring. Legal and professional, a lot more of this on the startup or when you get new renters. Typically not something that you're running into year over year. Now, management fees, this is something that's common, and just like the advertising, really if you have someone who's managing the property for you, this is going to be a full rental activity. There's really no reason why they need to manage you living at your own property or you using your vacation home. We'll just go ahead, we'll take the 10%. I believe we put 30,000, but 35,000, 10% is usually the rate that they apply. And as we go through this list, the tax software is doing the calculations for us. And I don't want to go through each and every item, as I think that could make for a rather boring presentation, but I think we've kind of got the gist of trying to think through these different items. What's going to be rental and personal use, where we're just taking a percentage? What are these items that are rental only? And I guess to kind of just put a bow on this and close out, really for the rental and personal use, try to grab as many items as possible. Since this is qualified as a rental property, regardless of the amount of time, if there's an expense associated with this property, at least part of it is always going to be deductible. The other real thing to kind of think about is just, is this something that is only for the rental, or is the owner also going to get some benefit from it as well? So with all of that being said, where I want to go ahead and navigate to next is let's go and talk about some travel expenses. And where we're going to go is I'm going to go back into my PowerPoint. Let's get the full screen here. And let's talk about some travel expenses. And the reason that I always like to talk about this is travel expenses, I feel like, more than a lot of different expenses that you could have, I feel like it's always kind of murky. Our clients are really, a lot of the time, doing things where there's some, travel that's going to be for the property. They're also going to do some travel that's on their personal end. And it could get a little daunting to report to the IRS. And I can definitely tell you, when I was new and just learning this field, my default instinct was always, if you're not sure, don't take the deduction. You don't want them to get audited. And there is some value to that. I think more than anything, what frustrates a client is if they get audited, even if it's not our fault, even if everything was reported correctly. I think there's just this like underlying bias that, I went and I paid $400 or $500, however much, to get my tax return done by a professional, and I still got audited. And sometimes I don't think they quite grasp that, our job is to report the information correctly, maybe know some nice deductions that not everyone else knows. But ultimately, at the end of the day, the IRS has its own internal guidelines. And just because you get audited doesn't necessarily mean you're doing anything wrong. But I guess I'm kind of going off on a tangent here. This is a conversation maybe for another presentation, but I think some of you could probably relate to that frustration that occurs. But the reason that I'm talking about this and bringing it up is, as I've gotten more comfortable doing tax returns, and as I've run into some of these gray areas time and time again, I've really reset my thinking in many ways to don't let them get audited, don't let them get audited, don't let them get audited, to, well, sometimes the audit's out of my control anyways. And when I really look at a lot of these expenses with the IRS, to be fair to them, they can be pretty generous with some of these deductions. In particular, I think they're more than generous when it comes to travel expenses. And we're going to dive into some specific examples that I think are a bit complicated and really work through them. But before we go ahead and do that, let us go ahead and just kind of work through this slide. Let me take a quick sip of water very briefly here. Okay. So the main things to know about these deductions and kind of the bullet points to always remember is the primary purpose of the travel must be for the rental property. And the key word within this is primary. You can have secondary purposes that have nothing to do with this specific property, and you will either be able to take all or part of the deduction still, but the primary purpose needs to be travel. And this is going to be, something that really requires your professional judgment on, is this primarily for their rental property, or are they kind of just the last minute shoehorning something in? And we'll kind of work through that. Next thing to know is the client must keep receipts to claim the deduction. The IRS is, even if they are somewhat generous with these travel expenses, if they do get audited, they are going to want to see the supporting documentation, and specifically those financial amounts that are justifying these deductions, because this can be something that's rather hard to keep track of. The IRS can be very, very strict on making sure that you do have the paper receipts or the digital receipts as well. And then lastly, just a little kind of potpourri grab bag. Meals are actually going to be deductible if it supports the business. And really, in this instance, the business is the rental property. Probably would be a better use of words to say the rental than the business. But, functionally, a lot of ways how the IRS requires this reporting, it's very, very similar. Now, some brief examples and some more, I think obvious or intuitive examples that will be deductible is just traveling to the rental property to perform any business activity. And once again, business rental could really be swapped out as the same words. And just to give you some brief examples, inspections, repairs, maybe they have a showing and the client that they're showing it to doesn't even sign on and sign the lease, but they still took their time, they took their gas, they took their mileage on their car to go and show off this property. That is still going to be fully deductible according to the IRS guidelines. Another, I think, pretty common example is traveling to Home Depot to purchase repair or improvement materials. And this is kind of an interesting one. If you had a strict business or you're going to work, the IRS isn't going to allow you to deduct your commute, right? And in many ways, you kind of think of it, well, I'm going to my property. It's almost like a commute, but to the IRS's designation, going to be completely different. Really, commutes and traveling to specific, income generating activities that aren't your job, treated vastly different. I'm not quite sure why the IRS has set it up this way, but just make sure that they're keeping a mileage log for some of these items. Every time they go to Home Depot and then the drive from Home Depot to their actual rental property, they're going to be able to deduct all of that gas, take all those miles. Last little item I think that is fairly obvious is traveling to the post office, send, collect mail. Maybe they have some late notices. They need to go. They have a PO box where they're running their business from. Every time they go to and from the post office, this will be fully deductible as well. Now, I think those are some great basic examples that we've gone over. Like I said, I always like to have a few basic examples, but let's go talk about something that's a bit more complicated. And what we're going to do is we're going to talk about this specific travel schedule here. And if you've ever seen my Maximize Schedule C deductions video, you're going to see this slide is very similar, and that's because the IRS is going to treat Schedule C deductions with travel and Schedule E deductions with travel basically identical. But for this specific example, I've set up a 6-day schedule where number one, or I should say on Thursday, we're going to be traveling to the state of Florida. And let's just say for this example, this client's business or home is located in Georgia, and all of their rental properties are also set up in Georgia. They have no rentals within the state of Florida. Now on Friday, after our day of travel, what we are going to do, or what they are going to do, is they are going to go to a rental property seminar. They want to learn the tools, the tricks of the trade. They're really trying to expand their knowledge to make them more efficient at their rental property and generating income from their rental property. Now, on the weekend, Saturday and Sunday, look at this. We're doing items that are not for business whatsoever. We are going to Disneyland. We are taking the family. Sunday, we're going to Universal Studios. Same thing as before. No work will be done on Saturday and Sunday. These are strictly personal days. To conclude the last 2 days here, we're going to have Monday, and we're going to meet with some clients. And by clients, I mean maybe we own a business property, and we're meeting with some potential investors that want to lease out this for their business. Or it really doesn't have to be a business property. It could be a personal as well. Maybe you have someone in mind that lives in Florida. They're looking to cross state lines, move over to Georgia, and you're going to go over some of your different rental properties with this specific client and try to match them. Really, the purpose of the meeting, as long as it is in regards to them signing a lease or about a rental property that you have, the specifics are not always important. The main thing to know about this example is they are meeting with the client. And then on Tuesday, they are going to go ahead and have a travel home, or excuse me, another travel day back home. And the way that I've set up this specific travel log was done very intentionally. And the reason that this was done so intentionally is the IRS guidelines are, in my opinion, they can be a bit finicky, but they're very specific. And this is a common travel log that I would recommend using with your clients and telling your clients about, because it's what it's called. It's called the weekend sandwich. And how this is set up is you almost have to look at the ends, meaning Thursday and Tuesday, and then move inwards. So typically we're going to have our travel day at the start of the trip and at the end of the trip. I think that's pretty much going to be every trip that you take, right? But how we've set this up is we have rental property seminar on Friday, which is going to be, in regards to our rental property. And then Monday, we're going to be meeting with clients. And because we've kind of put these at the end of our sandwich, this is the bread of our sandwich, what this is going to mean is that for Saturday and Sunday, all of their travel expenses, including the lodging for their hotel, are going to be deductible. And even though really the lodging on Friday night to get you to Disneyland Saturday and Saturday night to get you to Universal Studios on Sunday, really in no way could you say that that is in regards to, their rental property. But because it's set up in this format the IRS has given us, it's still going to be fully deductible. And this is a conversation and something to know when meeting with your clients, especially for tax planning purposes, that if I were to change up the order of this travel log, where Actually on Saturday we're going to Disneyland, but I'm going to meet with some clients on Sunday. And then on Monday, I'm going to actually go to Universal Studios and kind of swap Sunday and Monday. Well, what that would cause is it would cause all the lodging and all the travel for Universal Studios to not be deductible. You really do have to set it up in this format where the business is on the tail end on either side of your travel log, and then all of the fun activities are going to be in the very middle. And excuse me. And one more thing to make note of is that when setting this up, at least 58% of the days need to be business related. And when you're looking at this screen, we have 6 days that we're looking at, but really only 2 of these days are business related. But the IRS is going to consider these travel days as business days or rental days. So, take the travel days as income generating activity, and then just make sure the actual days meeting with your clients or expanding your knowledge of the craft are at least 50%. If you do that, this whole log is going to be deductible. And these are kind of the little tips and tricks that I always recommend that we try to memorize, or at least try to have some vague knowledge of when helping our clients. And I do briefly want to kind of take a quick detour out of PowerPoint and a little bit out of the tax preparation software. And I want to talk about something called the tax book. Now, there are many different tax research softwares that are out there. And here at Wolters Kluwer, we use the tax book in order to kind of give you a database to search these specific areas. And I'm going to go ahead and log in to my web library. Excuse me. And this is something that I relied on heavily, I would say, my first 5, 6, 7 years as a tax professional. If you were to go and look at the IRS coding for just getting a 1040 done, it's like 20,000 pages long. It's item after item after item. It's literally an impossible amount to memorize. Now, you will run into the same deductions over and over again by and large, but you typically have, one, maybe a handful of clients a year where they're just running into specific items that, they need a research credit for their business or for, whatever exactly. And I always recommend having some sort of research tool that you can use as a quick double check against whatever it is that you're trying to accomplish. I personally use the tax book. There are many of them out there. The reason I like the tax book is it will integrate with many softwares, where if you were to go into something like TaxWise Online and you had a specific question about a specific field, I'm not sure, how am I going to report mortgage interest? Well, if you click this little arrow, there will be tax help that you can use to go and learn about the mortgage interest. And I always recommend just having some sort of tool to give you a backup. And if you ever are thinking about getting tax research, just make sure that it's authoritative with the IRS. You want something where if you are using it and your client gets audited, you want it to be something that you can tell the IRS, well, this was my basis for doing what I did. And if you're using something like Google, Google can be your best friend. It can be your worst friend, though. Do you use something like Google, just finding an article, not really going to be something that we can use as a basis to authoritatively say why we did this with the IRS. If you get something like the tax book or another product out there, this is something that can really, really help you out. Now, looking at time, it looks like we have about 15 more minutes left in this presentation, and I have a couple more items that I want to go over, just some little quick tidbits to just kind of close out this presentation. And where I'm going to want to go is I'm going to want to go back into my PowerPoint, and I want to talk about depreciating a rental property. This is something that my first year, there's a lot of little tidbits with the IRS that can make this more complicated than it sounds. And to start off, I just want to give you an example. I haven't really dived into the specifics of, is this a partial rental, full rental? It's not going to overly matter. The main things to know is that when someone purchases a house, let's say it's a detached single family unit, they're really purchasing the house and the land. Now, the check that they're going to give or the mortgage that they're going to get is just going to automatically include both of these items. Now, the IRS is not going to let you take the land for the depreciation. And really their basis for this is that land is never going away. That land is, at least hypothetically, and I would say in almost every instance, going to be there from one day to the next, from 1 year to the next. So the land, they don't let you depreciate. And what you're going to have to do, either by appraisal or if you can find, government records, is remove the land from the purchase price of that property. And just for this basic example, I had a $250,000 total purchase price. We went ahead and separated the land, and that's going to give us the cost basis of $230,000. I think this is a rather basic item to kind of wrap your head around, but it is something that I've done peer reviews for other CPA firms. It is not always being done. It's very easy to just say, I don't know, it takes too long to look up. But if your client does get audited, this would technically be an exception. This would technically not be correct. Now, the next item to kind of talk about is, let's say we have a client and they have a rental, and this is a furnished rental. They have gone and bought all the couches, they bought the beds, and the person who's renting doesn't even have the option. They have to use this furniture. Well, is this something that is going to be depreciable for the Schedule E? And for this example, I've given $6,000. And I want to go ahead and open it up to our second polling question and just kind of see where everybody's feeling before we go and discuss this. I'll give you a hint. It's an all or nothing situation. Meaning there will never be an instance where you can partially depreciate. I think I may have given too good a hint there, as I think that kind of gave the answer away. But we'll give you just a bit of time here, and we can go ahead and get these answers and kind of see where this is going to land.
All right, we've got 82% voted, and the vast majority voted the same. So go ahead and share. And 86% said yes, while 11 said no.
Okay, yeah, and I think my hint was a little, maybe kind of gave it away there. But it's okay. This is just a learning experience. And the answer is going to be yes. Yes, it's going to be deductible. And really the things to think about are, is this furniture, one, purchased by the person who owns the property? If it is purchased by the person who owns the property, that is when you're going to be able to take the depreciation expense. If, for example, let's say they were not furnishing it, and the client and the renter is the one bringing in their own furniture, and when they leave, they'll be taking their furniture with them. That's when it's going to be a no. That's when it's going to be, this is something that cannot be depreciated. So you really have to make sure that you're getting that designation. Now, I can say that I would highly recommend that you tell your clients in their rental or lease agreement with who they are renting to, make sure that this is always stated within the lease. This is done for a few reasons. Number one, we're most concerned about the tax side of this. This is going to be the basis for the IRS, but then two, there can be legal disputes, especially if you have a person who has rented for a very, very long time. I'm talking double-digit years. If this is not included as part of that rental agreement, I have seen court cases in the past where the renter then tries to take control of the property, and there really isn't a way for the owner to have that justification that it is their property. So always a good idea. Always recommend telling your clients, make sure this is specified. Typically, I think most people that I work with, they just add a little checkbox to their leasing agreements. Is furniture included? Yes or no. You check the box. That's really all the justification that you're going to need to the IRS. It doesn't need to be overly complex or wordy. It just needs to go ahead and be located somewhere. And when it comes to inputting information into TaxWise Online, when it comes to depreciation, once again, you can see that given our different category codes, our rental and personal use and our rental only, this is another item that's rental only. Look, we don't even have the option for personal use here. And especially one of the things that I find when bringing on new clients, this can be a huge time sink. And there's really not a good way around it that year one. Year one, you are going to have to really input these various different furnitures. Here's my chair, here's my desk, here's any improvements that I've gone ahead and done to the property. However, the nice thing is that once you've done it year one, this is typically something that's going to roll forward. And from there, you're only going to be going and inputting the specific items that have been added on a year-to-year basis. And this is also an area where depreciation can really add up, especially in those beginning years when you're getting maybe some bonus depreciation potentially, depending on your method. Usually depreciation will be higher up front. And then another important thing to just kind of reiterate is the building itself, not the land, the building itself is also going to be depreciable. And there can be some huge time savings, or excuse me, not time savings, cost savings to your client. And it really gets back to that passive versus active income. You know, if this is an active real estate agent or an active renter, rental owner that's, you know, putting in the hours, the 8, 9, 1,000 hours a year into this, especially those first years, that depreciation can really be used maybe to offset some larger incomes from older rental properties. So always make sure you got the building on there. Try to capture as many assets as possible. This, in my opinion, is really where you can save your clients a ton of money. Just making sure that they're giving you everything. Make sure they save their receipts, as you will need it for your justification. Now, last little item to go ahead and go over here today is something that I think is very, very common within rental properties. And this is going to go ahead and be mortgage interest. I need to get back into my PowerPoint here. And the last slide that I want to talk about, and this is kind of a little bit more basic of an item, but the last slide I want to talk about is mortgage interest. You know, these 1098s that are mailed out by the lending institutions is another place where there can be a huge amount of savings and deductions that you can get for your clients. And I think something that sometimes people forget is that, yes, the largest number on this list is most likely going to be the mortgage interest received from the institution, right? Or the institution's receiving from the owner. But never forget to do the insurance premiums and also the points paid if this is going to be a new property. These points can be used as a deduction for your client. And then obviously the mortgage insurance premiums. And just to kind of get back to our example within TaxWise Online, when we go to our insurance premiums, this is one of these distinctions where it is going to kind of depend on this classification between our two categories. By and large, if this is something that is just being used as a rental, the full amount will go into the rental only column. When you're seeing that split use, that's when you're going to go ahead and need to calculate your percentage. Now, one more thing to kind of talk about is when it comes to these, let's say you have a property, but it's only for rental use. You are never going to live in that property for the corresponding tax year. Well, what happens if you run into a situation where you lose a renter mid-year? Or you don't have it filled the whole time. It's an Airbnb, but you don't use it. You had 0 days there, but you only rent it out half the year. Well, if you're running into that situation where there is no personal use that is mixed in with the rental use, just meaning every day that someone lived there, it was for rental use, you're not going to have to go and do this calculation, as the IRS is going to allow you to report this as a rental only property. So this is another distinction to kind of be aware of and make. The day that one of your clients, let's just say hypothetically your client spends 1 day in a rental property and then 180 days, they have gone and rented this out. Well, if we go back up to our distinction here, the personal use days are just going to be the days that they did not use that rental property. It was just sitting there vacant. And it can really mess with their deductions. It can really lower their deductions and make them quite a bit lower than they should be. And this is an interesting conversation to have with your clients, that sometimes if you have a rental property that's not being used at, that's being used, I'd say a middle amount. You're using it quite a bit, but it's not filled up for the full year. Is this worth taking a few rental days with, or is this better making this a full-time rental so you can take these full deductions and save money? I think an important thing to kind of look at in regards to this is how much money are they making, and is it active versus passive? If they are passive and they're really not reporting any income anyways, this doesn't matter, right? It doesn't matter if they're going to get more of a deduction because the biggest deduction is zero. But if they are active, that's really when you got to look at these figures and figure out, is this really worth losing the cost savings that you may get by just reporting this as a rental only. With all of that being said, this is going to go ahead and conclude my presentation today, going over the Schedule E. The last polling question that I'd like to go ahead and open this up to, and let me go ahead and make this full screen. I don't know why it's not full screen anymore. The last question that I'd like to ask you all, let me go and swap the views here, is just based off everything that we've talked about today. Would you like a more in-depth product demo and further details about TaxWise Online? We have three options here. We have yes, no, or if you're already using TaxWise Online, just let us know. There's a couple reasons we like to do this. If you are using, well, I guess the first reason is just letting us know who's coming to these presentations. Are you someone who uses TaxWise and you're just looking to expand your knowledge? If we have a lot of people that are already using TaxWise Online, that kind of lets me know, okay, let's focus more on PowerPoint, let's focus more on specific deductions. But if you're coming to these presentations and maybe you are thinking about switching tax softwares and you do want to learn more about TaxWise Online, which is what we offer, typically then I like to set these up to where we're really getting a little bit more into the tax software, getting into these specific examples, showing you how to set up the software to do the calculations for you. And it really just helps me know how can I best set up these presentations in order to serve the needs of my audience. So we'll go ahead and give you all a couple more, maybe 30 more seconds to a minute, and then we can go ahead and close down this presentation.
Ryan, I know we're a bit over time, but we did have a few questions come in. So if you're free to answer those, maybe we can get those answered as well.
Sure, we probably have time for a few questions. And I cannot see the questions, so if you could just pick a couple from the list.
Sure thing. And please feel free to ask any questions in the questions tab. All right, I'll go ahead and close this polling question now. And let me dig up some of these questions. Okay. First question from Victoria. When client sells the property that has passive losses carrying over time, will client be able to use losses against any gains?
I guess the short answer to that question is yes, but you have to keep in mind it can't go into the negatives. So yes, they have gains, right? So I'm trying to look for my slide here on my list. They have gains. Yes, you can use it against some of those gains depending on the classification, but just know that you can never have a net operating loss. That the least that they're ever going to be able to do is zero, just meaning that they're not going to owe any taxes. But IRS is pretty specific with most of these deductions, where most of the time, the overwhelming majority of the time, passive losses can only offset passive income. There are a few exceptions to this rule, but typically the IRS is going to have these as two separate category codes that you have to go and really know, where your passive is kind of in one bucket, your active is in another bucket, and you're really usually, I would say almost always, working from these different buckets when it comes to getting the largest deductions possible for your client.
Thank you, Ryan. And then we have Yuri asking, if a client has zero tax implications on their tax return for a state they do not live in, but own rental property, and do they have to file a tax return in that state?
It's really a state by state basis. I think as a general rule of thumb, most states are going to want to know. There are a handful though that I don't think need to. But one of the things to kind of think about when it comes to either the IRS or even like the federal institutions that are in charge of taxation, the rule of thumb that I operate by, and I think is a good rule to operate by, is typically they want to know. Even if you're not paying taxes, they're very observant and they want to know what's going on these specific tax returns, because if a client was ever to get audited, or if that situation changes year over year, maybe it was zero income, zero income, zero income, and then there's a large spike in income. A lot of times, these taxation agencies are going to want to go back and look at those previous years just to make sure that everything is on the up and up. I would highly recommend, going into the, specific laws and codes for the specific states to see. But if you're ever not quite sure, as a rule of thumb, just go ahead and report it, just so that you know that you're covering all of your bases.
Okay, great. And then Alexis asked, how do you get a basis for depreciating a condo that's a rental?
So it's a bit more complicated, right? Because, I live in a condo personally, and technically you are not going to be the owner of the land. You own the building on top of the land, but there's typically an HOA or a condo association that owns that land. Now, you kind of have to really think about, how is this condo set up? Typically, it's buildings where it's either almost like apartment style or townhouse style, where usually the outside of that purchase price, the person who owns that condo does not own the land. Now, there may be some specific exceptions to this rule with many things when it comes to taxation. You can usually run into some sort of rule or some sort of scenario that breaks the general rule. But as a generality, the land is typically owned by the HOA association, and then really you're just purchasing the building. And that is a really good question to think about. I have seen some people go and they technically do own the land before, and then from there it's really a lot more complicated. If you are in one of those situations where the land is typically owned by the person who owns the condo, they typically don't go and assign each plot its own value. And you would really have to go and find the total value of the land, find the number of owners or the square footage, and do a calculation from there. But luckily, most of the time, the land is owned by the HOA association. It's not something that you really have to worry about as much in regards or in comparison to when it's like a single family detached residence.
Awesome, thank you. And I know we're running through these real fast. Sandra asked if we offered the depreciation presentation. I don't think we've done one in the past, but maybe that is a good topic we can cover in the future. And then Emily asks, what if you have a client that puts an apartment they are living in or for the employees to use? They have a retail store and only use it till they get a place, but the owner stays there indefinitely.
Could you repeat that just so I make sure that I'm understanding the
Sorry.
question?
Yeah, me too. What if you have a client that puts an apartment they're living in or for the employees to use? They have a retail store and only use it until they get a place, but the owner stays there indefinitely.
So it sounds like there's an apartment and it's a mixed use apartment. You have an owner who's living there, and then you have employees who are temporarily living there. And there's also some mixed business use in there as well. So this is really two items in one. The way that this is worded, and this is how I'm going to answer it to the best of my ability, is it sounds like there's a business that is happening, right? This is a business. They have a retail store. They also have an apartment. The apartment, sometimes the employees live there so they can get fully stoned. So this would typically not be something that's going to be reported on the Schedule E. as there will be a section on like business returns for rentals. Now, the thing to kind of ask yourself is, are the employees living, or are the employees uh, uh, paying to live there? Are they paying a financial monetary dollar amount to the owner? If they're paying a dollar amount, this would probably be still counted as employee income. You know, I'm actually not quite sure now that I'm kind of talking through this, how this would be reported. Because I have two different ways of thinking about this. I have one way where I'm thinking about this where, you know, this is technically rental income that should be reported as a business income. But then I'm also kind of thinking about, I'm like, well, this is really an employee benefit if they're living there and they're not having to pay money. So what we can do is, why don't you give me that email address for that particular person? And I'm going to go ahead and use the tax book like I was talking about earlier. And I'm going to try to look that up. It's a very odd situation where you have an apartment and the employees are living there. I think it's really going to count if they're paying rent or not. But I think regardless if they're paying rent or not, this is going to have to be reported on a Schedule C or a business return, because the overarching theme of this is that it's for business. And it doesn't sound like the primary, I mean, it's definitely mixed use with the business use going on there. And then it doesn't sound like the primary revenue generating purpose of this building is to generate rental income. It seems like this is more of like a benefit that's either offered to employees or something that employees are paying for. But I can absolutely go and look this up after the presentation.
Awesome, thank you. And then Geraldine had, if they live in a property and rent room, what would we say the personal use they are? 36.5 and 36 for renter. 365.
So technically the person is living there full time, right? So the owner, I should say, is living there full time. So this calculation, you're not going to need to do, because the personal use days are going to be 365. Now, what this is going to do is this rental and personal use, this column will probably most likely be blank. However, don't feel like there aren't deductions that you can't take for your clients. Let's say, for example, you had to go and advertise to get someone to live in that room. You went and paid a service, you paid Google, whoever, to go and advertise this room for you. Well, that's still going to be a rental expense that can be taken. Let's say that you went and made some improvements. You went ahead and redid the flooring. Well, that still is going to probably be depreciable, at least in regards to this room. And sometimes you have to take a specific calculation of the square footage. You know, what is the square footage of this room that I'm renting out versus what is the total square footage of the house? You may run into that situation. But you really just have to think about it. You know, are these expenses that I'm running into, are these items that are rental only? When I have a new renter, am I just getting this one room cleaned? Or am I just going and saying, okay, I want the whole place cleaned? If you want the whole place cleaned, go ahead and take the square footage to go and kind of break it down. If it's something like advertising, it's fully deductible. But this, you know, fair rental days, personal days, you're not going to have to worry about as much. And I probably have time for one more question. I do have another meeting that I'm need to go ahead and run to. So are there any other questions that I could answer today? I probably have time for about one more.
Yeah, sure, thank you. Let me see. Is there any Quanta asks, is there any scenario where you would put properties on a Schedule C?
Typically you're not, because, you know, the rental Schedule C is business income. So typically if you own a rental, it's going to report on the Schedule E, is that's going to be rental and other types of income. The only exception to this rule would be if they have gone ahead and set up like a sole prop, and the whole purpose of this sole prop is the business itself owns these rental properties. And then from there, you're reporting it as a business income. But by and large, that's not even something I would recommend doing. I'd really recommend setting it up through the Schedule E. If you do want to set them up as a business that has multiple rentals, you would be much better off setting them up as a partnership or an 1120S corporation, just because it can minimize their own personal liabilities. In fact, if you did have someone who was set up that way, that actually, I would be thinking, this is a business opportunity for me. This is a client that is taking a very risky business entity type for their business, and pay me a fee and I can get you set up as the proper business entity type to really minimize your own personal liability for your business.
Awesome. Thank you very much, Ryan, for the thorough answers, and sorry to run this a little late, but I think the answers are appreciated. So thank you everybody for joining us. If you found today's session to be beneficial, please feel free to join us next month. The topic will come out shortly, so please stay posted. You can find us on YouTube as well. So any past recordings, including this one, will be on our YouTube page. So just search Wolters Kluwer or TaxWise and you should be able to find it. Thank you so much, and I hope you have a wonderful day.
Thank you, everyone.